Hi everyone and welcome to Learning Objective 1-2. And in this learning objective, we are going to determine periodic depreciation using both time-based and activity-based methods and to account for dispositions. So selling off an asset at the end of its useful life. That's what we're referring to when we say disposition. All right, so we're determining periodic depreciation using time-based and activity-based methods, and we're also going to account for dispositions. All right, so what are the different time-based depreciation methods? Well, the most common by far is straight line depreciation, and according to a survey that was done about 10 years ago of, I believe it was Fortune 500 companies, about 91% of companies said that they were using straight line depreciation as their primary depreciation methodology. There's also another method that's far less common. 1.7% of all companies said that they use this method, and it's called the double declining balance method. And the idea with this method is to accelerate depreciation. So in other words, we're trying to record more costs. We're trying to allocate more costs to the income statement. We're trying to record more depreciation expense in the beginning of an asset's useful life rather than later in the asset's useful life. And the idea here is that most of the value that an asset has is lost in the beginning of its useful life, and then it declines more slowly later on in its useful life. So we have an accelerated method that is called double declining balance. And then finally, there's also a methodology called sum of years digits, which is used hardly at all. Only 0.4% of all companies surveyed said that they use this methodology. And so the sum of the years digits is also a variation of an accelerated method of depreciation. But I would say in most cases, what you're going to encounter in your accounting career is straight line depreciation. With time-based depreciation methods, the idea is to allocate an asset's cost, right? Because we capitalized it, and so now we have to allocate that cost, expense that cost, record that cost in the income statement over the asset's useful life. And so with time-based methods, the idea is that we're going to recognize it based on the passage of time. With an activity-based method, we're going to record costs based on some activity. So for example, if we're an auto manufacturer and we have some special machine that we use on our assembly line to assemble our vehicles, we might depreciate that machine based on how many vehicles were produced from the assembly line. And that might give us a better idea of how the asset's value is used up, rather than saying it's based on the passage of time. So activity-based methods, it's essentially the same calculation as straight line depreciation, except in the denominator. Now remember the formula for straight line depreciation. With straight line depreciation, which is a time-based depreciation method, we're going to take the asset's original value and we're going to subtract its residual value, what we think we can sell it for at the end of its useful life. Let's say we'll go back to this pizza oven example that we had in the previous video. Let's say we buy a pizza oven for Explorer's Den. It costs us $20,000 to purchase, and we think at the end of 10 years, the oven we won't be able to use the oven anymore. It'll be too worn out. Even making repairs, the oven still will not be useful to us. But we think, it's made of metal mostly, and we think we can sell the metal for scrap, and maybe we can get $500 for it. So we're going to say the number that we want to depreciate, the cost that we have to depreciate, is the original $20,000 cost that we paid for the oven, minus the $500 that we expect to get back at the end of the oven's useful life when we sell that oven for scrap metal for $500. Right, so we're working with $19,500 of cost, and we have to allocate that $19,500 out over the useful life of the asset. The time-based method would say just spread it out equally over 10 years. Spread it out equally over each of the 10 years that you use the oven. An activity-based method would say, instead of taking the years and putting the years in the denominator of the calculation, you should take the number of, say, pizzas you think you can make using the oven and use that in place of time. So if we think we can make 1 million pizzas over 10 years with this oven, instead of dividing by 10, we would divide by 1 million. And what that would give us, what that calculation would tell us, is the depreciation per pizza that we make, which might be a better measure of how the asset is being used up, how this expense is being incurred over the life of the asset. So that would be an activity-based method. Another thing we have to keep in mind here is sometimes, or actually not sometimes, probably most of the time, as a company, we're going to buy a capital asset, a property, plant, and equipment asset. We're going to buy that asset partway through our financial year. So it's hardly ever the case that we buy the asset exactly on January 1st and we have a December 31st year end. That's hardly ever the case. What's more likely is that we're going to buy the asset partway through the year. We might buy it in March, we might buy it in May, we might buy it in June. Whatever the time it is, we have to be mindful of that, because in the first year, that first year that we buy the pizza oven, right? Let's say we buy it in June. We buy it on June 30th, right? When we go to do our time-based depreciation calculation, we say it's a $20,000 pizza oven. We can sell it for scrap at the end of its useful life for $500. So we'll do $19,500 divided by 10 years. And that will give us, that calculation will give us depreciation per year. But think about what's going on in the first year of owning this oven. In the first year of owning the oven, you did not get the full use of the oven for the entire year. You only were able to use the oven from July 1st till December 31st. So therefore, it would not make sense under a time-based method of depreciation to record a full year of depreciation expense in that first year. Instead, what you would do is you would take that full year depreciation rate that you get from your calculation and divide it by 2. And that would give you half a year of depreciation. Well, what if we bought it on September 30th and we only got to use it from October 1st through December 31st? So we only got to use it for October, November, December, 3 months out of the 12 that were in our fiscal year. In that case, we would say, let's only take 3/12 of the full depreciation, because again, remember, our depreciation expense number that we calculated is based on an entire year. So we're going to adjust for what are called partial periods. And partial periods have to do with situations where we buy an asset or we build an asset that we need to depreciate, but we buy it or we build it and it doesn't get placed into service. We don't start using it until partway through the year. And in that case, in year one, it does not make sense under a time-based method to record a full year of depreciation. Now, the nice thing about activity-based methods is you do not have to worry about this issue, because our denominator is not a time number. It's not years. Instead, what it is it's the number of pizzas we think we can make. So when we do our calculation of depreciation in year one under an activity-based method, we're only going to take the activity that was completed during the time that we own this asset. And so therefore, the activity embedded in it, it already has in it this effect of, or this idea that we only had the asset for part of the year. So there's no adjustment necessary. So let me repeat that and summarize that. With time-based depreciation methods, double declining balance, sum of years digits, straight line depreciation, if the asset is purchased and placed in service partway through the year, we need to adjust depreciation expense in the first year for partial periods. So we need to record partial period depreciation. On the other hand, activity-based methods, we do not ever need to adjust for partial periods because when we measure the activity, that activity is only being measured during the period that we own the asset. It's already embedded in this idea that we didn't have it for the entire year. That is already reflected in our activity number, and no adjustment is necessary. Let's talk next about disposals. So getting rid of property, plant, and equipment and intangible assets. What happens if we sell the pizza oven before it reaches the end of its useful life? What if our sales are not doing well and we have to shut down the pizza shop and we're trying to get any money that we can out of the business, and so we're going to sell our pizza oven? Okay, that would be a disposal. So when property, plant, and equipment is sold, a gain or loss is recognized for the difference between the selling price and the asset's book value. So the difference between what we sold the pizza oven for, maybe we sold it for $10,000 cash 2 years after we bought it. And at that point in time, we've taken 2 years of depreciation off of that original $20,000 value. And so therefore we're selling this asset at a loss. We're selling it for $10,000 cash at a time when it's worth much more than $10,000 cash on our balance sheet. So in this situation, we would record a loss. The selling price is lower than what our balance sheet says that this asset is worth after depreciation. Okay, so in this case, we would record a loss. But there are cases where you could have a gain. You sell an asset at a gain, or more rarely, you could sell it at exactly what you have it recorded for in your balance sheet. Okay, but it's always possible that we could have a gain or a loss when we sell a property, plant, and equipment asset or an intangible asset before the end of its useful life. And the basic journal entry is we're going to debit cash because we're receiving cash, right? So what comes into the company? Cash comes into the company. How do you make cash go up? With a debit, because of the accounting equation. The accounting equation says assets are equal to liabilities plus shareholders' equity, okay? So the left-hand side of that equation, assets are equal to liabilities and equity. Left-hand side, assets. The left-hand side of the equation, to make the assets go up, you do a debit. To make the assets go down, you do a credit. On the right-hand side, to make liabilities or shareholders' equity go up, you do a credit. And to make liabilities or shareholders' equity go down, you do a debit. So it's the reverse. They're mirror images of each other, and it works perfectly because it's an equation. So the debits have to match the credits. The assets have to equal the liabilities plus the shareholders' equity. All right, so back to this, right? So what we're talking about here, we need to record the journal entry for the sale of an asset. All right, so we're receiving cash. How do we make cash increase? Well, we make cash increase because it's an asset. We make it increase with a debit. What else is going on? Well, we are selling an asset. So how do we reduce the value of the asset we're selling? It's no longer ours. We need to remove it from our balance sheet. Well, to make an asset go down, you do a credit. So you credit the value of the asset you're selling. But you'll remember from Accounting 101, when you have a property, plant, and equipment asset, you also have accumulated depreciation, which is a contra asset account. So a contra asset is an asset account that behaves like a liability. So how do we make a liability go down? How do we make a liability go down? You make a liability go down by doing a debit. So to get rid of accumulated depreciation, you debit accumulated depreciation. So you debit cash, you debit accumulated depreciation, you credit the asset that you sell to remove it from the balance sheet. And then if this entry does not balance, what you have is a situation where you sold the asset at a gain or a loss. If you have too little credits, you record a gain. If you have too little debits, you record a loss. All right, and so hopefully this is making sense. And let's conclude here in Learning Objective 1-2, talking about group and composite depreciation methods. So group and composite depreciation methods aggregate assets to reduce the record-keeping costs of determining depreciation. And so the idea here is that you take multiple assets that have similar features, such as vans, trucks, wagons, And so these are technically different assets for our company, right? You have a van and a truck, and then you have a wagon associated with the truck that you attach to the truck. And so they're not exactly the same, but they're close enough. And in this situation, GAAP will allow us, for record keeping purposes, to simplify things. You can kind of add up the value of these assets and depreciate them as a unit. Multiple assets depreciated together. And so this would be called a group or a composite depreciation method. All right, well, this concludes our discussion of Learning Objective 1-2. I hope this has been helpful. Thank you for watching. I'll see you real soon. Take care.